You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. Welcome to the Options Playbook, the program where we break down cutting-edge option strategies and explain how you can incorporate them into your own portfolio. Whether you're looking to grow your capital with some offensive maneuvers or protect your investments with defensive plays, you can find them all in the Options Playbook. The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities LLC, member FINRA and SIPC. Now, let's open the playbook and get started.
Welcome to Options Playbook Radio. I'm your host, Brian Overby, Ally Invest Senior Options Analyst and author of the Options Playbook. Boy, what a day. So focus has finally shifted, in my opinion, where it needs to be, looking at the FANG stocks. We had a lot of big news in the marketplace to go along with a lot of crazy news in the marketplace from last week when we taped Options Playbook Radio. Today we are taping. It is Wednesday once again. The date is February 3rd. It is the day that Google, or i.e. Alphabet, announced earnings. The Dow was up about 36 points today. The SPX was up about 3 points or so, pretty flat. The VIX actually came down a little bit. We're trading right around the 23% level, so came off quite a bit from its craziness of last week. And we have the NASDAQ down just a couple of points. So as far as the overall market was fairly uneventful. We had two of the biggest stocks in the U.S. marketplace announce earnings yesterday, Amazon and Google. Mr. Bezos decided that he is going to basically retire from Amazon, and so that made Amazon be real crazy. That stock was down about 67 cents or $67 after a decent earnings report, and it traded all over the place, up, down, sideways. Aftermarket couldn't decide if it was good news or bad news if Mr. Bezos wanted to become the chairman and step down from the day-to-day. But the stock we looked at last week was Google. And I'm going to point out one thing to start with is that after listening to last week's Options Playbook Radio, I mentioned on that podcast that the expected move for Google at that point in time when we were looking at it based off of that implied volatility last week going into the earnings was 140. And interesting enough, Google closed today. Now it was all over the place after earnings, but it closed today up 139 points. So 139.76 to be exact. It's just interesting when stuff like that happens. I do not know exactly what the expected move was yesterday, but based off of our show that we did last week, that was the number that we mentioned, and that's just basically looking at the long straddle at that point in time, and it's just interesting to see that the stock actually closed almost exactly on that number. Okay, so this podcast is all going to be about pricing because so many interesting things happened on this trade. And as always on Options Playbook Radio, we're just trying to learn. So we're paper trading a lot of these and just basically trying to follow the prices, try to understand what's going on. And Amazon and Google are always very interesting stocks to follow the week of earnings because they're such high price stocks. They have decent volatilities, and eventually at expiration, when we have weekly expirations, all that time premium, all that juice that's in these high flying stocks has to go to zero. Time decay has to happen. There has to be an expiration date. So last week we mentioned the February 5th expiration. And last week would have been January 27th. That was a Wednesday. The market was closed. We did mention that we normally would look at this trade on the Tuesday of the event. Google was announcing earnings after the close on Tuesday. And that would normally be the day that you would trade at it. But we taped the podcast on Wednesday. So we did it the week before to talk about the Google earning. So with that said, I mentioned on the podcast that you might want to look at this trade and apply the same concepts to the Tuesday closing price or trading a little bit closer to the actual earnings report. But if you did not, and you actually woke up the next day and put on the skip strike butterfly that we talked about, well, then you should have been out of it getting into earnings, because what happened from Tuesday of last week, or I should say on January 27th, the close, that closed the stock, and I'm going to round off here, was at $1,820 on that Wednesday, January 27th, when we taped. And by Tuesday of the following week, the 2nd of February, the stock had ran over 100 points. It actually closed fairly close to 1930. That's about where the close was on that Tuesday. So 110 points to the upside. We were bullish. We looked at a skip strike butterfly, and bullish is relative. Whenever you're looking at those trades, you're bullish, but you don't want the stock to go through the roof. And the stock had already ran up over 100 points. So I would not have taken the risk of the earnings report. I would not want that risk because that trade was pretty profitable overall. Now, it's not as profitable if you just bought a call outright, that's for sure, but obviously you didn't have as much risk on that trade either. So I would have took the risk out of the picture. So let's go ahead and talk about the trade that we did on that Wednesday in last week's podcast. We looked at the February 5th expiration. We talked about an expected move of 140, saying that our risk is more to the upside. That's where our maximum risk would be. The market went down, we were actually going to gain on this trade. And so we went out, we looked at 140 points out, and then we added another 40 points. So with the stock at 1820, we ended up buying the 2000 strike February 5th expiration, selling the 2040, two of the 2040 February 5th expiration, and then buying one of the 2120, hence skipping the standard butterfly strike of the 2080. We were able to get that done for a net credit of $1.65 to the account, $1.65. So for every 1x2x1 skip strike butterfly that we looked at, we brought in a net credit of $165 less commission. Now, since we did skip that strike, we did have a requirement. We mentioned that. It's $4,000. It's nothing to sneeze at. It's a real trade here. So you would have had that margin requirement overall. And this is part of the reason why you probably would have just got out of the trade instead of allowing that earnings announcement to happen after you had a decent run up in the underlying stock. So what happened then? We brought in that $1.65 credit. The stock ran up a dollar. Now, based off of the close, I just happened to be looking at it. Obviously, most people were looking at Google and Amazon before their earnings, and I noticed that it had ran up that much. So I took a snapshot of the option chains, and at that point in time, you did have an increase in implied volatility, so that kind of hurt you a little bit overall. But at that point in time on that day, you could have closed this out at an additional net credit, if you filled it at the midpoint, of about 90 cents. So I put it on for $1.65. I had a net credit of 90 cents. I would have probably closed that out. If anything, maybe I'd close it out and do another skip strike butterfly and set it up at a different area where I'm going to have the profitability. I would have applied the same concepts and just moved it up, and I would have taken that profit and ran. So overall, not meant to be a recommendation, but real interesting that stock moved that much. And in general, you'd think that you would probably be up a little bit more on that trade, but implied volatility also increased overall as we went in, and you still got to buy back those short option contracts that were very expensive going into earnings. So the fact that I could get it on for a net credit of $1.85 and then turn around and sell to close, buy to close, sell to close that position and actually get that done for a net credit of the account of an additional 90 cents, I would have just done that and just closed out that trade. Okay. Now, if you didn't close out that trade, as we mentioned, the expected move was 140. We went further out. We almost ended up right on the strike. We came very close. At one point in time, we would have been on the strike. So I did mention also in the call that if it opened above the 2,000 level, that you would just close it and you would get out. So you should have done that in the open. If you didn't, if you rode it all day long, right now, the stock has moved too far in general. I would be out of this underlying trade the way that we had it set up last week. We had the Google February 5th expiration, 2,240, 2,120. Those were the strikes, 40 points wide. So we had an 80-point range that the underlying stock could really land in, and we would be okay. We actually went a little bit beyond that. Today, the stock closed at 2060, which is right on our bad area, right? So from 2080 to 2120, that is where we are the most nervous on this trade. Okay. We're right close to that level, so I would have wanted to get out during the day. The market had run up at one point in time. The high for the day was 2,100, right? So not quite to our long protective strike, but it came close, and you definitely should have been out before then. But if you weren't, and you wrote it all the way to close, bottom line is right now, you could close out this trade that we put on for a net credit of $1.65 to the account. We have 2 more full days worth of trading, all day Thursday, all day Friday, and you could get this done for a midpoint. Now, the markets are closed. I want to tell you that, so a little bit artificially wide. But based off of the closing market prices, you could close this out for a net credit of $5.50 to your account. Okay. Put it on for $1.65, sell it for $5.50. We bring in overall, so we got $5.50 plus $1.65. We're looking at $7. So $700 for every 1x2x1 butterfly that we put on. And if you would have adjusted going into this, you actually would have done better overall. As a matter of fact, you might actually want to think about riding it a little bit. Why? Because as we mentioned, we went 180 points out. The expected move was 140 based off of last week's at the money long straddle. So if I was looking to do that trade on the Tuesday, when the market was at closed on Tuesday at 1930 at that point in time, I would have wanted to go an additional 180 points out, which means that the underlying stock would be just below our long strike with a couple of days remaining to trade. Almost the ideal scenario. You would be up on the trade, in theory. As time decay eroded, you would need it to start going above your long strike, your first strike in the butterfly, and towards your short strike. That would be the ideal scenario. But this would be a perfect scenario to try to ride it out, try to make a little bit more capital if you still think there's a little bit more bullishness to the upside on Google. So, interesting trade overall. Once again, one of the big benefits of this trade in Google was that when you have a higher price stock, you can go wider on your strikes and still get it done for a net credit. That is a huge benefit here based off of the prices from last week, because if your long option is 40 points in the money, your in this instance 2,000 strike call option, it's got to be intrinsically worth $40, right? Because time decay is going to go away. And that's a huge benefit to help you in this battle against basically time premium and time decay. So, yeah, real interesting. If you were watching it all day long and you're glued to your computer looking at the butterfly prices, they were all over the place today. You basically, because of the market activity, you would be putting in orders with wide bid-ask spreads and just trying to feel where the actual market is at to try to get filled and adjusting them a lot. But that's the way you would trade. That's the name of the game, especially in higher price stocks. On paper, I would just be working off the midpoint. That would be your best guess as to where you could fill it at overall. But yeah, fun, very interesting trade. So let's do something different. We got a couple more minutes here. Let's go in and just let's do a rinse and repeat on Google. Earnings are done. We still have a lot of volatility overall. And once again, it is Wednesday. We've got all day Thursday, all day Friday. Why don't we just use that same methodology on Google and do a skip strike that will also expire this Friday? I would be out of that trade for sure that we talked about last week. And even if I would have waited and went until Tuesday, I'd still strongly consider getting out of this trade after today's move anyways. So how would we set one up today without any volatility? So if I do still have the Ally Invest option chains up in front of me overall, and we're still going to work with that February 5th expiration, because the underlying stocks that this is interesting in are very expensive stocks. And we've talked about doing these type of trades in indexes like the S&P 500 index. We've looked at that mainly because there's such an expensive underlying that adds a lot of premium, and that time premium has to go away by this Friday because it's expiration. So that makes it that's what makes these underlyings in particular the most interesting to do. Okay, so as I mentioned today, Google closed at 2058.88. 2058.88. We're going to call it 2060. So let's look at the 2060 strike call and put. And if I look at that long straddle, we're talking now about a 40-point move. So to highlight last week before earnings, it was a 140-point move for the expected move. Now it is a 40-point move for the expected move. So we want to go at least 40 points out, and that is going to put us at the 2100 level. But if we can go a little bit further, because our risk is to the upside, we will do that. So we're going to start, and we're not going to be able to go as wide. We're not going to be able to go 40 points wide just because the vol premium isn't there. So we're going to have to go a little less. We'll go 30 points wide. And we're going to buy the 2120 strike call. We're going to stay bullish on it. We're going to sell the 2150 strike call. We would skip the 2180 strike call, and then we'd go out and buy the 2210 strike call. Be very similar to the setup that we had before, but obviously we're going 30 points wide. So there is additional risk to the account if we do that. And if we do this whole trade right now, we can get this done for a net credit of about $1 to the account based off of where the underlying market is at right now. So we'll make that the paper trade this week. We're just going to put that entire trade on, see where it will open in the morning, but we're going to try to go 30 points wide in the morning if that's possible. If not, maybe we have to break it down to 25 points wide, but we want to do whatever the trade is where we can still get it done for a net credit to the account. And we'll watch it. We'll watch it as expiration approaches, and we'll see what happens. The main reason why I want to get it done for close to it is for some type of net credit to the account is that if the market stays where it's at or drifts lower, then that's going to be your maximum gain. Your maximum loss in this instance would be if the underlying stock actually opened above 2110 or 2210. I'm sorry, 2210. That's our long strike. If it opened above that 2210, well, then we could lose our maximum. But here's one of the big upsides of this. We still have a lot of volatility in these, but we don't have that news event. We don't have that risk, as much of a risk of the gap opening as we did, of course, around the earnings event. We're still trading at about a 30% implied volatility. That's back to the more normal range. And that's normal in this environment, not, prior to the pandemic. It'd probably be back down around the 20% level or 25%. But we're trading right around 31% implied volatility. That equates to a 41 point expected move. We're going to go a little bit further out and buy the 2120 strike call, sell 2 of the 2150 strike calls, and then buy the 2210 strike call overall. All right. That's it for this episode of Options Playbook Radio. If you have a topic you'd like us to discuss on the show or a question you'd like us to answer in the program, you can send them directly to me at theoptionsguy@invest.ally.com. Thanks for listening. We'll be back at the same time, same place next week. Until then, may all the options you bought finish in the money and all the ones you sold finish out.
The Options Playbook is brought to you by Ally Invest. Anything mentioned today is for educational purposes and is not a recommendation or advice. Options involve risk. Please refer to ally.com/invest/disclosures to review additional risks involved with trading options. Securities offered through Ally Invest Securities, LLC, member FINRA and SIPC. You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.